What if I told you you could buy a home with almost no money down, even with a credit score that's not exactly perfect? Sound too good to be true? But here's the kicker. It's 100% possible, and you're probably more qualified than you think. The reality is you don't need a massive down payment or flawless credit history to become a homeowner. FHA allows you to buy a house with as little as 3.5% down, even with a credit score as low as 580. And if your score is hovering around 500, you're not out of luck. You can still qualify with 10% down payment. 500 credit score and you still get approved, that is 100% accurate. But here's what most people get wrong. FHA loans aren't just for first-time home buyers. They're not just for people with bad credit, and they certainly aren't a last resort. In fact, FHA loans can often offer better interest rates than conventional loans and allow for higher debt-to-income ratios, meaning you may qualify for more with less stress. So if you've been sitting around on the sidelines thinking homeownership is out of reach, think again. We're going to discuss the 2025 FHA loan requirements, some busts, some myths, and show you exactly how to take advantage of this loan program. So let's go ahead and get started. Buckle up. All right, let's be clear. Let's clear this one of the biggest misconceptions up right away. FHA loans are not just for first-time home buyers. FHA is for anyone that meets the requirements, whether it's a first time or your 10th time. The reason it's often associated with first-time buyers is because it's a lower down payment and more flexible requirements. But in reality, you can use an FHA loan multiple times. The key reason FHA is a great option for many. It has the most flexible guidelines out there, allowing higher to debt-to-income ratios and offering better interest rates compared to conventional loans. But here's something most people don't realize. FHA loans can be a game changer for self-employed borrowers or those with non-traditional income. If you're self-employed, you probably know the struggle of writing off expenses and showing a lower net income on your taxes. With conventional loans, this can make it tough to qualify for a mortgage. FHA, on the other hand, is far more forgiving, thanks to its higher debt-to-income ratio allowances. FHA loans give self-employed borrowers more flexibility in what they can actually afford. If you have additional income sources such as rental income, side businesses, or even sporadic contract work that don't always show up in the traditional manner, FHA's looser DTI requirements can help you qualify for more house than a conventional loan would allow. This is a huge advantage because conventional lenders tend to have to stick to income verification policies. FHA looks at the bigger picture, making homeownership much more accessible for entrepreneurs and gig-type workers. They're called compensating factors. Look into it. Now, before you rush out and apply, let's talk about some qualifications. Meeting FHA's minimum requirements doesn't automatically mean that you're going to get approved. That's because different lenders have what are called overlays, extra requirements they impose on top of FHA's basic guidelines. One lender might approve you at 580 credit score like we do, while another might require a 640 score. They will not go below 640. You have to do your due diligence. Another key requirement is to be aware of the county loan limit. FHA sets maximum loan limits based on the county where you're buying. These loan limits vary depending upon whether the area is considered low cost or high cost. For example, in high cost areas like California or New York, you might qualify for a significantly larger loan than in the lower cost regions elsewhere. These limits adjust annually and can impact how much home you can afford with an FHA loan. It's essential to check the FHA loan limit for your specific county before you start your home search, or certainly just talk to a lender, talk to us, we'll help you out. It's crucial to work with a lender who understands FHA loans inside and out, and one that doesn't pile on unnecessary restrictions. Your credit score plays a major role in determining what kind of loan you qualify for, and FHA loans are one of the most accessible options for those with lower scores. If your credit score is between 500 and 579, you'll need 10% down. If your score is 580 or above, you only need 3.5%. But credit scores don't just impact down payment, they also affect your interest rate. The lower your credit score, the higher the interest rate, the higher the increase in your monthly payment. However, since FHA loans are backed by the government, they often have more competitive rates compared to conventional loans, even for borrowers with lower credit scores. Another thing to consider is that lenders may have their own minimum score requirement. While FHA technically allows you to go to 500, many lenders won't approve loans unless the borrower has at least a 580 and 620, 640. Those are two thresholds that are pretty common. This is why shopping around and working with an experienced lender is crucial. Your credit score is calculated based on several factors, including payment history, 35%. On-time payments are the biggest factor in your score. Even one late payment can have a significant impact. Credit utilization uses about 30% of your score. This refers to how much of your available credit you're using. Keeping your credit card balances low can help boost your credit score. The length of credit history. The longer you've had accounts open, the better. New credit inquiries. Applying for too many loans or credit cards in a short period of time can absolutely have a negative impact on your score. A credit mix. It's like a diversification of your portfolio. Having a mix of different types of credit cards, auto loans, student loans can actually be beneficial. If your score is currently low or too low to qualify, there are many ways to improve it before applying for an FHA loan or any loan for that matter. Paying down credit card balances, making payments on time, and avoiding new debt can all help raise your score over time. Let's put this into perspective. If you're buying a home at $300,000, you're putting 3.5% down. That means $10,500 that you're putting down on down payment. But don't forget, this doesn't include closing costs, which can add another 2 to 3.5% of your home's price. Sometimes you can negotiate with the seller to cover closing costs, or you can use gift funds from a family. Either way, be prepared for more than just your down payment of that 3.5% or that 10%, depending upon where your credit score lies. So is an FHA loan the right choice for you? It depends. If you need a lower down payment, have a lower credit score, or want more flexible DTI ratios, it's absolutely a solid option. Just keep in mind that mortgage insurance requirements and lender overlays. Let's talk a little bit about that mortgage insurance. It's one of the most misunderstood parts of FHA loans is, in fact, the mortgage insurance. Unlike conventional loans where mortgage insurance can drop off once you hit 20% equity in the home, FHA mortgage insurance stays on for the life of the loan unless you put at least 10% down, in which case it falls off after 11 years, no matter what the value of the house is. This means that if you put down less than 10%, your only option to remove mortgage insurance is to refinance into some sort of conventional or some other option type loan once you've built up enough equity in your home. Additionally, FHA also requires what's called an upfront mortgage insurance premium, which is 1.75% of the loan amount. This fee can be rolled into the loan or financed into the loan, increasing the total amount that you're actually financing. So it's not necessarily doesn't have to come out of pocket. However, many borrowers misunderstand this fee, thinking it benefits them, but in reality, the mortgage insurance only protects the lender, not the borrower. It exists to safeguard lenders against default, allowing them to approve riskier type borrowers with lower credit scores and smaller down payments. Now, for example, if you take out a $300,000 FHA loan, your upfront premium or your upfront mortgage insurance premium would be $5,250 added to the total balance. While this increases the amount you owe, it enables you to secure financing even with lower down payment and credit scores. So you're buying at today's prices versus tomorrow. It's important to factor in mortgage insurance costs when deciding if an FHA loan is the right fit for you. While FHA lower down payments and flexible credit requirements make homeownership accessible, the mortgage insurance obligations mean that refinancing in your future may be necessary to reduce your overall costs. So it absolutely is something that you need to take into consideration when you're deciding whether it's an FHA or a conventional loan is right for you. One of FHA's biggest advantages, higher debt to income ratio. Here's how it works. Your front end DTI, which is your housing expenses, which is The new monthly mortgage payment, principal, interest, taxes, insurance, and any sort of HOA fees, it can go up to 47% of your gross monthly income. Gross, not net. Your back-end DTI, which totals your any debt, including car payments, student loans, or any other credit card debt that may show up on your credit report, including the new mortgage, can go up to 57%. Here's an example. If you make $100,000 per year, that breaks down to $8,333 a month. FHA allows you to go up to $3,917 for your mortgage payment and up to $4,750 for all monthly debts combined. This is one of the highest DTI allowances for any loan program, which means FHA, they can help you qualify for more house than a conventional loan. For borrowers carrying significant student loan debt or any other obligations, this expanded DTI flexibility can absolutely be a lifesaver. While conventional loans typically cap their back-end DTI at 45 to 50%, FHA's 57% cap allows for more room for managing other financial responsibilities while still qualifying for the mortgage itself. Additionally, FHA loans consider compensating factors that may allow for higher DTI approvals. For instance, if you have significant savings, a strong credit score, or make a large down payment, a lender may approve you even if your debt load is on the higher side. This is especially beneficial for self-employed individuals and gig-type workers whose income may fluctuate. Because FHA is more lenient with income calculations, borrowers with variable earnings may find it easier to qualify compared to conventional loan programs. Overall, the FHA's high DTI limits provide borrowers with more flexibility and purchasing power, making homeownership even more possible, even with existing debts. FHA loans are not just limited to single-family homes. They can also be used to purchase various types of properties, making them a versatile option for buyers looking for a different housing solution. Single-family homes, the most common property type purchased with an FHA loan. This includes detached homes, townhouses, and even some manufactured homes that meet HUD guidelines. Multifamily properties, the 2 to 4 unit properties, one of the biggest benefits of FHA loans is the ability to purchase a duplex, triplex, or a fourplex with just 3.5% down. However, you must live in one of those units as your primary residence for at least 1 year. This makes FHA loans a great option for house hacking, allowing you to live in one unit while renting out the others to cover your mortgage, increase your monthly cash flow, add more money to your principal balance. Lots of different options if you're able to utilize that. Condominiums. FHA loans can also be used for condos, but the condominium complex must be FHA approved. Many condos are not FHA approved these days, so it's crucial to check this before making an offer. In some cases, you may be able to get what's called a single unit approval if the complex meets FHA financial stability and owner occupancy requirements. Manufactured and mobile homes. FHA loans can absolutely be used to purchase manufactured and mobile homes provided they are permanently affixed to the foundation and meet FHA safety and livability standards. Typically, we're going to need to have some sort of engineering cert done as well. Keep that in mind. Renovation and fixer-uppers. FHA 203Ks, if you're looking at a home that needs repairs or updates, an FHA 203K loan might be the solution. This allows you to finance both the purchase price and the renovation costs all into one loan. There are two types. Limited 203K loan covers minor repairs up to $35,000, and then the standard 203K loan used for much more major renovations and structural changes. New construction absolutely can be used. FHA loans can be used to finance newly built homes, but the property, again, must meet FHA appraisal and inspection requirements. No matter which type of property you're considering, it must be your primary residence. FHA loans cannot be used to finance vacation homes or pure investment properties unless you initially occupied one of those units in a multifamily property or occupied it at one point and then exited and to buy another one. So is an FHA loan the right choice for you? Like most things, it depends. If you need a lower down payment, have a lower credit score, or want more flexible DTI ratios, it's an absolutely solid option. Just keep in mind that mortgage insurance requirements and lender overlays can play a role. The most important step, get pre-approved. Don't just assume you qualify. Talk to a lender, have them review your finances, and get a clear picture of what you can afford. If you need help, my team and I are here to guide you through the process. Click the link in the description to get started with a free, stress-free consultation. And hey, if you found this video helpful, do me a favor, hit the thumbs up, subscribe, drop a comment below with your biggest FHA takeaway. We'll see you on the next one. And that, my friends, as always, was another guaranteed video.